Passive investing through ETFs have given investors the chance to have their money in something they know nothing about. They simply want money in the stock market, and they can easily trade broad indexes, commodities, anything really. While this has some very clear positives, investors are unprepared for events that will take place in which liquidity will be drained from the market and will leave those holding ETFs with extremely low valuations for an undetermined amount of time. Are you ready? You came here for the truth, so let me unveil that for you. Today I have several topics that I want to discuss surrounding the financial system. We are going to look at what's happening with passive investment through ETFs. We are going to talk about the market today. We're going to look at both stocks and bonds. I have a lot to cover, and I wanted to begin by taking a look at this. Stocks are poised to hit another record this week, yet investor mood has darkened. So there is an expectation that the market will be able to go beyond its previous highs. This, of course, is talking about the US markets. We're not looking at global markets in general. And of course, the more attention that you pay, you will see that there are actually a handful of stocks that have created the state that we are in today. While the S&P 500 itself is less than 2% from a record high, fewer than half of the stocks in the index are even within 10% of their own 52-week high. You have to understand how important this is, because you look at Amazon stock and you see one picture, but if you look at the broad market, it's showing something else entirely. And this has been going on now for nearly 2 years. That leaves a lot of room for catch up in discount stocks if economic atmospherics improve, but it also suggests a winnowing of the fit from the faltering in what most still see as a late cycle moment. So to put that in plain English, essentially we are looking at a group of stocks that are definitely, no doubt about it, doing better than the general market. Now, of course, they are constantly trying to make people buy stocks, put their money into the markets. That's what these websites and these channels like CNBC, like Bloomberg, they are there to do so, because if everybody's selling, if everybody is not buying, that means they're not buying from their advertisers. They have a reason to do this. But what I am here to do is simply show you the data that they're not willing to get into. And we'll talk about that more in a minute. I just wanted to show you what they said here at the bottom. It was quite interesting. Investor surveys and fund flows continue to reflect caution more than an interest in playing a further rally. Goldman sentiment gauge based on stock index futures positioning is neutral, far more muted now than it was when the S&P was at the same level in late July. Clearly, there are concerns here that have built up, and it goes far beyond just the trade tensions and dispute between the US and China. Although that's the primary focus, we know that we are late in the cycle. There's no doubt about that. The facts are all there for those who are willing to look. I just wanted to show you what has happened. Just in this short period of time, we have watched the 10-year treasury go from 2% down to 1.5. It's like it fell off a cliff. And that, of course, tells you that the bond market knows what's up. Do the investors at large? So we can look at particular indexes, we can look at particular groups of stocks, the FANG stocks, for instance, and then we can zoom out a bit and we'll see that in many cases, it looks like the market isn't where it was back last year. Okay, and we could have actually taken this a bit further and to see all of the way through 2018. January 2018 was the peak for many markets, still unable to get past those levels. That's weakness. That is very apparent. But if you're not looking at this as a top-down view, you're not going to be able to see that information. But here it is. We're just looking at several indexes all on top of each other. Certain ones have definitely performed better than others. But you just have to look at things like the small caps. When you see what has happened over these years, you know that there's a big change. And 2018 was really the biggest difference in between all of the other years prior to it. In 2015, 2016, we saw global weakness that was happening. Everybody was thinking that, okay, this is probably it. But then the central banks started to go in to devalue their currencies more, and we know the rest of the story. However, the weakness that we saw in 2018, in my opinion, was much, much worse. This right here is talking about Tuesday's trading session specifically. Very bad day for momentum tilted quants. Long short basket returns follow. Global effect, US below. Haven't seen this type of extreme movement in value since March 2009 and May 2009 for momentum. So you'll see that at the bottom, minus 5.5%. I just think it's interesting to see all this data and how it all adds up, where people are putting their money into, for example, value stocks, what they believe will be able to weather the storm, instead of looking at others that were doing better, let's say throughout 2017, and now they know that things have changed. Throughout the trade dispute between the US and China, we have seen some outright lies, we have seen some miscommunication, we have watched things fall through the floor, we have watched as we were told one thing and then they were going behind the scenes and doing something else. All of this has been to prolong while they were working things out behind the scenes. This right here, what I'm about to show you, is by far the stupidest thing that has come out from this entire fiasco since day one. The little munchkin here strikes positive note ahead of trade talks, says the US and China have a, quote, conceptual agreement on enforcement. Now, I have to actually give you the full quote in just a second here, but number one, this is what people are looking for, okay? The algorithms as well as the traders. They're looking for some sort of positive news on trade. It doesn't have to be real. They just need something to anchor to. That's simply it. Unbelievably, the public loves this. They eat it up. And of course, you will see this time and time again. The markets will trade higher on this information. When we find it to be false, the market stays where it is. It doesn't trade down as a result. That's how you know we have direct and complete manipulation of the stock market. His actual quote was this: I think the enforcement area we at least have a conceptual and agreement on. That's his quote there. Now think about what that means. There's nothing whatsoever there. It simply means that they have an idea. And we knew that 1 year ago. We already knew that they want a trade deal, that there are certain points that need to be made. But yet they're coming out right now telling you this as if it's new information, and the market loves this. The algorithms love it. They will consider this to be positive trade news. They will consider this to be progress, and yet nothing is there. All it means is that both sides have an idea as to what they want. That is the most stupid thing that we are presented with. Thank you very much, CNBC, for making this seem positive when it is absolutely nothing. I want to take a look at what's happening with some of these corporations. You know, we've talked about the buybacks before. We've looked at this on a deeper level, and there are some things here that I need to touch on as we move into the next topic. Apple, Disney, Deere, Caterpillar, and Coca-Cola were among blue chip corporations that rushed back into the debt market the first week after the summer's end with nearly, if you could believe this, $75 billion in issuance of US investment-grade corporate bonds, the most in a week since 1972. So this is huge here. It's a type of financial thinking from the C-suite that occurred after a massive August decline in yields, which resulted in extremely low borrowing costs. So you have to figure when things become cheaper, people and corporations take advantage. Okay, this works the same if you're going to refinance your home. This is the way that people do things. It's the same way that corporations do as well. But what happens when these corporations are able to finance anything that they want to do with debt? Well, of course, they have been buying back their own shares. Imagine that. They finance the debt, create a way that it's extremely cheap to do so. They lobby the government to do so, and then they buy back their own shares, which allows the executives of these corporations to benefit largely over everyone else. Companies are borrowing a lower cost than they could just a few months ago, and it's the same thing for mortgage financing. Companies want to refinance with such low rates. We will see big companies with strong balance sheets and that can add leverage at a very cheap price. It's an opportunistic valuation thing. Imagine this, okay? This is what they have done for the last 10 years. They have been using cheaper and cheaper and cheaper debt all the time. And then you had interest rates that marginally increased over this period, and things started to slow down at a rate we've never seen before. Like we've talked about, you need to put more dollars into the system to get the same amount back. It's unbelievable, but that's where we're at today. Insiders head for the exits. This gives you some of the corporations: Amazon, Facebook, Apple, and Netflix. You could see here they do talk about the fact that Jeff Bezos being the primary seller here, $2.8 billion from Amazon in general, and the number one seller had been Jeff Bezos, potentially because of what's happening in his personal situation. But he's not the only one at Amazon. In fact, it said, but other Amazon insiders have also been selling, and while the company may comfortably sit atop the insider selling leaderboard, other tech companies are on the podium. Facebook 377 million, and you see the others here as well. This just shows you what's going on. You see that there is a level of insider selling we have not seen since leading up to the financial crisis. Many people would say this is nothing, it's not a point to be made, nothing here to see, don't worry about it, the reason is this, the reason is that. I get it, don't worry about it. However, we have seen this going at a rate we have not seen since the financial crisis, so that, as far as I'm concerned, is yet another indicator. It's just another indicator, that's all. It isn't the most important indicator, it's not the yield curve inversion, it's not what's happening with PE ratios, it's none of that. It is one indicator, okay? And you have to take all of them. You can't simply ignore some and say, well, you know what? No, I don't want to pay attention to that. You have to add that all in. Everything makes up your decisions, everything makes up what is happening today, and you can't ignore things just because you don't like it. And finally, leading me to this point, talking about passive investing. Passive equity fund assets will surpass active by 2022. A lot of people don't understand, why is this a problem? So what? I own this 7 shares of ETF, and so it's fantastic, it's wonderful. Things have been doing well in the markets, and therefore I'm able to profit from it. Of course, you haven't sold, so you haven't actually profited, but this is what we are looking at right now. As you can see on the chart, that's the projection by 2022. Let's see what happens during the next recession. This is the way it works, of course, if there is no recession. So we'll see what happens in the future. This is from the EPFR, who tracks all of this anyway, so you can see it as it occurs. I will bring that to you. This information right here is not understood by the majority of people who have ETFs, and it is so important and will be so crucial during the next crisis. There is no such thing as price discovery in index investing, and there will be no price discovery on the downside either. The stocks that have been blindly bought on the way up will be blindly sold. When these markets do finally have a correction, there will be no bid for many of these stocks. People are not worried about this, however they should be, because so much has been invested, and you will find that with no bid, you're going to have a problem valuing some of these companies for a period of time. That could go on for a while. A lot of individuals simply think that, well, you know what, we're not going to have a housing crisis, subprime crisis like we did back in 2007 into 2008, therefore you don't have to worry about stocks declining that much. Okay, sure, you might have 30%, 40%, but it's a correction, great opportunity to buy more. But they just don't understand actually what's happening in the markets today and how they are very different from 10 years ago. Really quickly, 2 more things before we finish off the video. I just wanted to show you the world economy, the GDP by country as of 2018, just to give you a broad sense of how things look, because we're always focused on China, the United States, maybe Japan, and so on, Germany in here as well. But I wanted to give you this because HowMuch.net took this and put it into a graph that kind of makes it easy for us to see. Look at countries, for example, Italy, $2 trillion, Spain, 1.43 trillion. Even countries that everybody speaks so highly of, Switzerland, is less than $1 trillion, 0.71. Even Turkey is larger than this. I mean, we have to understand how all of these countries together make up the global economy, and that, of course, would tell you some insight as to what we can expect during a recession, during a crisis, trade issues that are going on, who are the alliances that are being formed, what about imports and exports, and so on. I just like to look at these type of things to really wrap my head around issues that come up in the media. I mean, it's interesting to see see things geographically sometimes, and as well as visually. It just really helps to understand not necessarily what's on this chart here, but as information comes up to try and process that. And this is unrelated, but I just wanted to show you something because it is really interesting. Redfin produced the housing downturn risk score, and although of course nothing is a problem, there's never going to be a problem, but they did put this out, which was interesting. You can actually put your mouse over it just to give you an idea of these different markets. Los Angeles housing downturn risk score 63.7% gives you the sale price to income ratio 10.9. That's extremely high. Average loan to value and so on. This is really informative because certain areas are definitely overpriced, other areas are much more reasonable, and looking at something like this gives you an idea. If you are buying a home, if you are selling a home, if you are looking in investing in real estate, if you don't know all of these numbers, you are really just buying completely blindfolded. So you should take a look at this. A link will be in the description under the sources. I'm going to end the video there. If you found that informative, hit that thumbs up button. By clicking one button, you make a unicorn smile. So I wanted to thank you for that. If you want to know how to build a business you're not sure, well then I have what you need. It's the Amazon GPS. It's an absolutely 100% free e-course for everybody to learn step by step how to sell on Amazon. It's growing every day, and in the next little while it will become, I'm sure of it, it will become the biggest e-course on Amazon in the entire world. So definitely check that out, theamazongps.com. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z, the 4 asset classes, how to profit, tax incentives, everything you need. Link in the description. If you want the audiobook, that's available at themoneygps.com. Hang on, hold on. I am literally the only person on the entire internet that covered this extremely important issue related to the Federal Reserve. I can't believe it. I did a search online. Nobody else touched it. I don't know why, but if you want to see it for yourself, click on it and I will see you there.